In this video, I'm going to talk about 3 FTSE 100 stocks that you might want to get your hands on next month. Let's have a look back over the year. It has certainly been a bit of a roller coaster. We've seen the year starting out at FTSE being in around 7,500 points, and that has done a big swing up to a high of just over 8,000. First time it had broken that figure ever in February. And then we see several months later it dropping the whole way back down to just over 6,700 points. And that's a swing of almost 10% within 4 or 5 months. It has bounced back up over the last fortnight, but is there going to be further volatility? I think there probably is. You've seen the FTSE being driven by the big oil companies, the miners and the banks. And if we think about all of those, they are all potentially in a little bit of danger, with price coming down for oil, miners struggling to have that demand coming in from China, and then the banks, obviously the interest rates have been driven up. We're potentially looking at another 25 basis point movement at the next meeting of the Bank of England when they meet in August, and that could see us go up to 5.25%. We've also got to think about what is going on with currency exchanges. If we think about it, we have about 75-80% of the FTSE 100 companies make their money from overseas, or it's derived from sales overseas. So the pound being strong really does play a huge part in this. And that probably drives it slightly more than how well the whole UK economy is doing, because you are making money from outside. And then if you also think about it, if you have the Bank of England raising its interest rates, the pound becomes stronger, and therefore you see that generating less income for these big FTSE 100 companies that are pulling in money from overseas, particularly for things being bought in the US dollar. And then we see the flip coming in. If we see rates coming down, you then end up finding those FTSE 100 companies that are reliant on imports being hit lower profit margins. I suppose what is quite interesting is to have a look at news that we had last week with CPI coming down. So we've just dropped below the 8% mark, coming in at 7.9%, but it is still over the Bank of England target of 2% by almost 4 times. There is still some work to be done to bring that down. What we have seen with that news coming in over the last week, we've seen the stock market go on a bit of a rally. It's starting to peak off a little bit, but are there some stocks out there that might be really worthwhile buying into? A few that I'm having a look at is Rio Tinto, and looking at that because I'm trying to build out my mining coverage, and it is up about 12.1% over the last year, coming in with a great dividend of about 7.2. We do need to bear in mind that it has cut its dividend back last year, but it has a payout just slightly above what I like it to be, coming in at that 64% payout ratio. Rio has been really good in paying out dividends to its investors, and last year it paid out about $8 billion. Obviously, this dividend is going to be very closely tied to whatever is going on across the world and that global demand for the products that it mines. So looking at iron ore coming out of Australia, and what is going to happen with China. Is China going to start to see that productivity, that GDP increase? It is in a sort of stagnation / deflation period at the moment, but as soon as it does pick up and we start to see growth coming back into the China market, there will be more requirements for some of the materials that some of these mining companies actually go for. And one of the things that Rio's going to be really looking forward to is whether or not their copper gold project in Mongolia and also the lithium project in Argentina, whether that is going to position them for long-term growth. Second one is Legal and General, and we all know that this has been a massive dividend favourite for many people. I hold all three of these stocks that I'm going to talk about in my portfolio at the moment. That doesn't mean that it is the thing to go and buy and invest into. Make sure you do your own due diligence and don't just listen to somebody on YouTube saying, I've bought this, go and do it yourself. Do your own due diligence, and if you need to, go and speak to a financial advisor before making any investing decisions. Legal and General has done really well over the years, has had a steady payment of that dividend, but just because it's done well in the past doesn't mean that future performance is going to match that. Share price has dropped about 6.79% over the last year, but it's coming in with a decent dividend payment of about 8.3% and coming in at about my sweet spot of that 50%, coming in at 51% payout ratio. Financial year 22, Legal and General has done reasonably well. It's seen its operating profits rise by about 12%. And that's up to about £2.5 billion. And its return on equity coming in at about 21%. A lot of this growth, about 23% of this growth, came from international markets, branching out into the US, Asia, and Europe. It does have a really good dividend, and I suppose this is backed up by having that diversified portfolio. So it's not just looking at pensions, it's got annuities, it's also got equity release products, and provides solid growth. More importantly, they have announced a full year dividend increase of 5%, and that's up to 19.37 pence in 2022. So they always look to reward their shareholders, and hopefully that continues. One thing that I've talked about in this video is that the CEO is going to be changing and being replaced on the 1st of January. And what really is important for a company like Legal and General is steady management and management that you believe in. So let's see how this replacement comes in. Third and final company that I'm going to have a look at is Taylor Wimpey. And I know everybody's going to say, house builders, is this really a good time to buy into house builders? Is there potentially any better time to buy? Over the last year, Taylor Wimpey is down just under 6% at 5.89%, coming in with a good dividend yield of 8.3% and coming in at about my sweet spot of 52% payout ratio. They have been really busy over the last year, seeing UK completions of just under 14,000, coming in at 13,929, and group operating cost is up quite considerably from the doldrums of 2020, and it's back up to pre-COVID levels, coming in at 829, and group revenues coming in at almost the same levels as pre-COVID. Some of the things that are potential worries are sort of the new landlord rules that have come in, the removal of the first-time buyers incentive help to buy. So they were things that were helping newcomers and people getting that first step on the housing market ladder. But sadly, that is gone at the moment. But there's obviously the thing to think about with home building. There are not enough houses within the country, and we do need that long-term growth to take place. So is this a perfect opportunity to come in and buy into a home builder while prices are at a reasonable price? That is something that I think you're going to see taking off in the next couple of years as we come out of sort of this period of the interest rates going up. Do we see those dropping off a little bit next year as inflation starts coming slightly more under control, and potentially we start to see a bit of a boom in the housing market again, with people trying to get their foot on the housing ladder? There's just 3 stocks to have a quick think about. I've done some other videos on dividend stocks. Why don't you go and have a look at that? And thanks very much for watching, and I'll see you in the next one. Cheers, bye.